This week's episode is brought to you by Crown Haven Wealth Advisors, your retirement reimagined. Coming up today on RetireSHIELD TV.
That you could simply use bonds. It's not going to support a whole lot of spending. Historically, you might be looking at something more like the 2.5% rule.
Right.
So if you want to spend more than that, the investments world is saying invest aggressively.
Right.
Stocks hopefully will outperform bonds, and that'll allow you to spend more in retirement. So the tax code gets really complicated, and it goes just beyond the income tax rates. It can really impact a retirement and requires planning to have the most tax efficient retirement outcome as well. There are people who really value the idea of, well, if I can find something that will solve for my lifetime need, I'm comfortable committing to that, to check that off my to-do list, to not have to be as worried about it anymore.
Knowing people and building trust. Get on the right path to achieve your retirement goals with Casey Marx and the team at Crown Haven Wealth Advisors. Understand the process and challenges of retirement planning. Discover the keys to a successful retirement.
Hello and welcome to RetireSHIELD TV. I'm consumer advocate Morgan Patrick, and as always, I am joined by the founder and CEO of Crown Haven Wealth Advisors and creator of the RetireSHIELD process, Casey Marx. Casey is not only the author of Baby Boomer Retirement Boot Camp, he is also a retirement income certified professional as well as a certified financial fiduciary. And today we have a special guest. Wade Pfau joins us. Wade is a Ph.D., a CFA, and like Casey, he is also a retirement income certified professional. Wade, welcome, and Casey, take it away.
Wade, I want to thank you for being here again, sir. We really appreciate you taking the time to help educate our viewers.
Absolutely, thank you.
We were talking off camera about how, the retirement income planning field is a relatively nascent industry. This is something that hasn't been around for very long. And a lot of these preconceived notions and presumptions that were made about retirement planning, or just what folks should be doing when they hit those crucial years of pre-retirement and retirement, have kind of been shattered over the course of time, especially with the dissolution of pensions, recent market turmoil over, let's say, the last 25 years or so. So the first, I guess, where I would start is when folks come into our office, they talk to us a lot about the 4% withdrawal rule, which for our viewers at home, it's essentially, you should be able to take out about 4% of your portfolio on an annualized basis, and you should be okay. My question to you is just based on the research, does that work? If it's a risk-based portfolio, let's say you're passively investing in the market, is that going to work for you? And if not, why?
Well, and I mean, the answer is it might work, but it's not at all clear in advance whether you're going to be a retiree that it works for or not. But yeah, I mean, the 4% rule in some way, you could say, was the birth of retirement income as that distinct field in financial services. Right. Bill Bengen was a financial planner based out of California who published an article in 1994 that gave us what we know today as the 4% rule. And it was a pretty simple type of idea, but it was pointing out something important. It's the article that introduced sequence of returns risk to financial planning, because what he was responding to was people saying, well, if the stock market averages 7% a year after inflation, let me plug 7% into a spreadsheet, and then it looks like every year I can take out 7%. I never dip into my underlying asset base. I get to grow my spending with inflation and never going to run out of money. And Bill Bengen said, no, hold on, that doesn't sound right. and so what he wanted to do was just get a better sense of the fact that even if the market averages a particular number, it's volatile. Some years markets are up, some years they're down. And if you incorporate market volatility into it, what does that do to a sustainable spending rate? And what he found is he looked at US historical data. He said, well, let's plan for a 30-year retirement. That's one of the assumptions of many assumptions in the rule. Let's plan for 30 years. If we got the historical market returns from, say, 1926 to 1955, from 1927 through 1956, and so on and so on and so on until now, 1993 through 2022, how much could I have spent as a percent of my retirement assets, and then sustain that spending with inflation and not run out of money for at least 30 years? And with that US historical data, the answer was 4%. It was, if you had the market returns from 1966 to 1995, and you used a portfolio of 50 to 75% stocks, which is another assumption that's actually pretty aggressive compared to what people usually hear about for retirement. But if you have that aggressive asset allocation, if you don't have to pay any investment fees, if you don't have to pay taxes, all these other types of assumptions, 4% was the answer to the question, how much could I have safely spent from an investment portfolio over a 30-year retirement based on US historical data?
What I'm hearing, and just to kind of summarize for our viewers, what I'm hearing is this was really the first attempt to create a reliable retirement income plan from something that is inherently volatile. The inherently volatile marketplace, and those assumptions were based on no fees being charged, no taxation occurring. It was including inflation. Was it including inflation, or did I get that wrong?
Yes, it did include
It was
inflation.
including inflation. So the one thing it was accounting for was it was accounting for inflation, but it wasn't accounting for the cost associated with the investment, and it wasn't accounting for taxation, which are two big things. And then it was also assuming a relatively high concentration in equities, which is something that folks typically don't keep. Is that also a fair statement?
Yeah, that's right. And there's no 4% rule when you start lowering your stock allocation much below 50% stocks, because bonds historically just haven't been able to support that type of spending rate over that long of a time horizon.
Right, and this makes perfect sense from a practitioner standpoint when we build out retirement maps for our clients. And all I'll do is I'll simply shift it to, let's say, all T-bills. And we'll show them how well that will work over time with the 105-year average of inflation built in. And their retirement will just go like this. Their amount of assets just declines over time with inflation because it just doesn't sustain itself. So really the only way to get there is either take excess risk or have some sort of a floor for income. Would that be a fair statement?
And that's really how you can think about retirement, that you could simply use bonds. It's not going to support a whole lot of spending. Historically, you might be looking at something more like the 2.5% rule.
Right.
So if you want to spend more than that, the investments world is saying invest aggressively.
Right.
Stocks hopefully will outperform bonds, and that allow you to spend more in retirement. The insurance answer to that is, no, let's pool that risk.
Right.
And let's be able to then have everyone live at a lifestyle like they'll have a more average type of market environment, more average type of longevity. And then that's a way to allow for a much higher level of spending than bonds alone could support. And so people have the option. Do they trust the market to fund that higher level, or do they want that insurance protection to have that higher level of spending?
And that's really the fundamental question that our viewers should be asking themselves. Do they want to trust the market in order to create that secure income, or do they want to create an income floor? And that's a personal question that needs to be asked for each individual person. But really what it comes down to is that is why we do diagnostics for each of our potential clients, to show them exactly how their portfolio aligns with or contradicts their stated intentions, and whether or not it's going to be sustainable for the long term. But I want to thank Wade for being here, and now I'd like to let Morgan kind of let our viewers know how they can take action if they'd like to.
Absolutely, Casey. So it's all about having the plan. We're about to take a quick break, but if you want your own personalized RetireSHIELD plan or a free copy of Casey's book, Baby Boomer, again, Retirement Boot Camp, make sure to call the number that is on your screen right now. Talk to one of our representatives and book that appointment and grab that book as well. Or you can visit our website, RetireSHIELD.tv. Again, that website is RetireSHIELD.tv.
Memories with Grandpa.
My first job.
My fourth job.
Crazy road trips.
Our first date. Meeting our son.
Exploring our world.
Our world. Family and friends. Our special song.
Secure your retirement by meeting with your local, independent, and fiduciary advisor at Crown Haven. Take advantage of your complimentary relationship visit by calling Casey Marks and the team at Crown Haven today.
Hello and welcome back to RetireSHIELD TV. I'm consumer advocate Morgan Patrick, and as always, I am joined by the founder and CEO of Crown Haven Wealth Advisors and creator of the RetireSHIELD process, Casey Marks. Casey is a retirement income certified professional as well as a certified financial fiduciary. And today, of course, a special guest. Wade Pfau joins us. Wade is a Ph.D., a CFA, and like Casey, he is also a retirement income certified professional. Casey?
All right, Wade, so we were talking last segment about the 4% withdrawal rule. Does it work? Our answer was kind of, it depends, right? But when we're talking about a risk-based portfolio, how do taxes impact that withdrawal rate? How do we plan for that? How do we look at that, and what kind of impact can it have?
Yeah, so the 4% rule was designed with ignoring taxes, and that's a big part of that research, is typically to just not even get into trying to mess with taxes because the tax code is so complicated. Right. One of the things I did during the pandemic was just build out all the models so that I could incorporate taxes into something like the 4% rule. But to really note the impacts that it has, and if somebody had all their assets in a Roth IRA, that's where you paid taxes in advance. You don't have to pay anymore. There's no impact on the 4% rule. So you could say the 4% rule assumes everything in a Roth IRA. But as soon as you start talking about a taxable account or like a tax deferred, an IRA, where you got the tax deduction when you made the contribution, but you have to pay income taxes when you bring the funds out, and you have to worry about required minimum distributions, potentially forcing you to bring out more than you necessarily anticipated or needed to spend, that can have a big impact on the 4% rule. The taxable account, it's just you don't get the full growth of each year's market return because you have to pay taxes on some of that. If it's interest, if it's dividend payments, if you're selling shares and realizing capital gains, you have to pay taxes on all that. And that takes a haircut off of the 4% rule, so that net of taxes, there is no 4% rule with a taxable account. And then with a tax deferred account, like an IRA, that anything coming out is treated as ordinary income. Of course, that can have a big impact on taxes depending on the tax bracket that you're in and so forth. And really at that point, if everything was in an IRA, you'd say 4% is the pre-tax number. Right. And then whatever your taxes are, you only get to spend what's left after that. With the caveat that required minimum distributions may actually make that situation worse because it may be forcing you to take out more than you wanted to spend and paying more taxes. And then you can always reinvest what you don't want to spend in a taxable account. But in the meantime, those extra taxes you're being forced to pay are no longer then available for future market growth. So taxes can have a big impact.
Right. And would you say that most advisors or most people that you've talked to, other professionals, would you say that they're doing an adequate job helping their clients prepare for this? Would you say that there's a huge gap? Would you say that there is, or where is the knowledge gap, and where's the practical application of this in your experience talking to other folks in the field?
I think there's a range of experiences there. As we discussed earlier, being the director of the Retirement Income Certified Professional Program, I do tend to deal with the more educated advisors in the world. And I think they are taking the steps to be able to provide this sort of support for their clients with tax planning. But there's plenty of advisors who don't even maybe know what the 4% rule is, let alone the tax impacts on it, who just are not in a position to help their clients at all with tax planning. But in the retirement planning guidebook, the longest chapter in the book is on tax planning, and just gets through it. It's not just federal income taxes or state income taxes. It's also Social Security, and how $1 of income can also cause you to pay more taxes on Social Security so that your overall tax rate is higher. It's also Medicare premiums, and if you exceed certain thresholds, suddenly you have to pay higher medical premiums 2 years later, not in the current year. It's a real mess and a real complicated situation. There's other sort of tax torpedoes or tax tricks as well. There's I may have $1 of income come out of my IRA, but I had some capital gains that were treated as long-term capital gains. That might push $1 of my long-term capital gains from the 0% to the 15% preferential tax bracket. That ends up compounding how much taxes I had to pay on that dollar distribution. So the tax code gets really complicated, and it goes just beyond the income tax rates. It can really impact a retirement and requires planning to have the most tax efficient retirement outcome as well. But again, the simple 4% rule doesn't really address any of that.
Yeah, and what I'm really hearing, and I'm sure our viewers are kind of, their heads are probably spinning at this point, but what I'm hearing is that it's incredibly important to be working with a retirement planner that truly understands all of these different ripple effects that can be created, and how all of these different disparate areas of finance relate to one another, and how to manage for that. And that's honestly, when it came to the RICP program that you were the director of when I went to the American College and received that designation, that's really what that designation sets you up for. It gives you the ability to kind of quarterback all of these issues and understand how they all interrelate, so that you can deliver that level of service when it comes to these types of things, because it's so important. There are so few people out there that work in the advisory space that have put the time and energy into the retirement stage, which is totally different, as we've spoken in past segments, from the accumulation stage. We've talked about, taxation impact. When we come back, we're going to talk about the fee impact. But what I want to get to our viewers, just so they kind of understand what they can do to take action now if they feel like, maybe they don't have a plan, or they're working with an advisor, but these topics have not been discussed or addressed, or they don't feel certain about that, is I want to give Morgan an opportunity to kind of let them know how they can get in touch with us.
Well, it's pretty simple. We're going to be back on the other side. We've got to take a quick break. But before we do that, want to remind you to join thousands of Hoosiers that have already shielded their retirement with a personalized RetireShield plan. Our lines are wide open right now, and they're open for you, so you can call the number that is on your screen. Okay, call it now, and our representatives will handle that phone call for you. Or you can visit our website, RetireSHIELD.tv. That's RetireSHIELD.tv for your own personalized RetireShield plan or a free copy of Casey's book, Baby Boomer Retirement Boot Camp.
Do you know what that sound is? It's me traveling the world. Europe to Asia. I'm vacationing and living the retirement of my dreams because I just met with my advisor at Crown Haven. They helped me turn my nest egg into a golden egg. Take advantage of your complimentary relationship visit by calling Casey Marx and the team at Crown Haven today.
Hello and welcome back to RetireSHIELD TV. I'm consumer advocate Morgan Patrick, and as always, I am joined by the founder and CEO of Crown Haven Wealth Advisors and creator of the RetireSHIELD process. Casey Marx is here. Casey is a retirement income certified professional as well as a certified financial fiduciary, and today we have a very special guest. Wade Pfau joins us on the program. Wade is a Ph.D., a CFA, and like Casey, he is also a retirement income certified professional. Casey?
Yeah, so Wade, the last couple of segments we were talking about the 4% withdrawal rule. Does it work? Does it not? The safe withdrawal rate from a risk-based portfolio, how that works with taxation considered, whether or not the 4% withdrawal rule was even considering taxation. What's the impact of fees on a risk-based portfolio? How does that affect the longevity of funds? Because that's really what we're driving towards here.
Yeah, it's an important question because I mentioned how the 4% rule has a lot of assumptions built into it. In particular, it's assuming investors earn the indexed market returns. So there's no fees or anything. It's just you earn the underlying market returns. And also, you're a perfectly rational investor who's comfortable with 50 to 75% stocks. Never panic in the face of a market downturn. Always rebalance right on cue at the start of every year. never make any sort of deviation from the required asset allocation strategy. Now, when you start to move away from that people might underperform the market indices, either because of behavior or because fee drag. There's expenses on investing. If they're working with a financial advisor that charges expenses based on the amount of assets they have invested, that all impacts something like the 4% rule. Now, it's not a one-to-one thing. Sometimes people make that simple idea of, well, if you have a 4% rule and then you're paying a 1% investment management fee, maybe it's a 3% rule. It's not quite that dire, because that would imply 25% of your potential spending is going to investment fees. But it's not insignificant either. It's really, and the idea is, with the 4% rule, your spending always grows with inflation. But as you're spending down your assets, the fees are a percentage of the remaining assets. So the fees would get smaller. So you generally, if the fee is a 1% number, you'd have to take a haircut of about 0.5 or 0.6% off the withdrawal number. So the 4% rule now with a 1% fee would be something more like a 3.4 or 3.5% withdrawal rate, which is implying somewhere in the ballpark of like a 10 to 11% type cut to spending to being able to cover the fee drag and or just underperforming relative to the underlying market indices.
And that's significant. So, and correct me if I'm wrong, Wade, but what you just said essentially is if you're being charged 1% on a portfolio, it equates to essentially a 10% cut on the spending plan that you otherwise would have had. So you can almost imagine, 1.2 months of spending gone over an annualized basis. Is that a fair way to look at that?
Yeah, that works just fine. Absolutely.
So this is incredibly important, and a number of good points were made there. But I think just to bring it back down to earth for people, fees and expenses dramatically impact the portfolio's longevity, and it's extremely important to ensure that you, number one, know the fees you're paying, and then number two, are certain that you are receiving value for those fees. One of the things that we see on almost a daily basis is, and I'd like to maybe get your opinion on this too, Wade, at some point, we see fees being charged for passive investment strategies. And then, you spoke to the behavioral component of it. Advisors are not impervious to the same behavioral tropes that we hear of over the course of history that the average investor is, susceptible to as well, right? So we see a lot of advisors that make knee-jerk reactions. And if you're doing that on top of a cost, if you got sort of the passive investment, but then you've got a tactical type of advisor who's trying to get in and out, or just relationship managing and doing kind of what the client wants when the client panics, that can also significantly deteriorate the portfolio over time too. Would you say that that's an accurate statement, or?
Right. If the advisor is making the behavioral mistakes as well, then they're not really providing that value for their fees. Because, certainly at the end of the day, the way, research in this area generally estimates that when someone doesn't have any sort of advisor or coaching, they tend to underperform the overall markets. Vanguard had a study about the behavioral coaching that an advisor can provide would add about 1.5% returns to the typical household portfolio. So if the advisor is doing that and helping the client stay the course, they could add more value than the fee drag. The client would be in even worse shape without the advisor.
Right.
But certainly, if the advisor is charging these fees and not providing that sort of behavioral coaching to stay the course in the face of market volatility, then absolutely it's the case that the fees that they're charging are not really leading to a better outcome. And this is also important too, because an annuity may not be right for everyone, but to have a fair conversation about it, annuity pricing generally has any sort of fees baked into it, so that it's assuming fees. And if you try to compare that to an investment strategy where there are no fees, like a simple 4% rule that's not assuming any fees, you're not really making a fair comparison. If you're going to look at real annuity pricing, you have to make some sort of fee assumption about the investments that you're using as well, to just have not be apples and oranges at that point. And that's a big problem, because it's natural to talk about investments as though there are no fees, when the reality is there are, and they can have a big impact on sustainable spending.
Right. Yeah, and you introduced a very interesting wrinkle there, which is you're essentially paying the advisor for the behavioral component, assuming it's a passive investment strategy. And if they're not doing that, then you're really not paying for them to do their job, which I think is extremely extremely important. And that's a very difficult thing too, because when you talk about the psychology and the confidence, people typically will blame the advisor when the market goes down. So that's a very difficult position for both the client and the advisor.
Mm-hmm. And we're still at a point where I think some advisors might pitch their service as providing alpha, that they're going to somehow outperform the market. But the academic research is pretty clear that it's incredibly difficult to do that on a consistent basis. And so advisors are not really adding value just by doing that sort of tactical type investing strategy that they might market themselves as being experts at.
Right. And well, then you have the speed of execution, the research that it takes, all the other practical items that would be required to even try to do that properly, let alone the validity of the argument in the first place. But it's a very interesting discussion, and I appreciate it. I want to close with this, because I know that you've done an abundance of research on this topic. Can you talk a little bit about the concepts of, kind of commitment versus optionality when it comes to a strategy for retirement?
Yeah. So some research I did with a colleague of mine, Alex Margia, where we really try to understand what factors impact kind of the psychology behind retirement and choosing an approach to building a retirement strategy. And we did talk earlier about, like, one of the important factors was this safety first versus probability based. Right. But yeah, the other important factor is this idea of optionality versus commitment. Optionality is, I really value keeping my options open. I don't want to make any decision that's irreversible. I want to be able to respond to new opportunities, to make changes to my strategy, and so on and so forth. And some people think that way. And of course, at the end of the day, everyone likes optionality. Right. but also, the opposite of that is a commitment orientation. There are people who really value the idea of, well, if I can find something that will solve for my lifetime need, I'm comfortable committing to that, to check that off my to-do list, to not have to be as worried about it anymore. Potentially, there's some nuances around that may help protect other family members if something happens to me and I've been the one managing the household finances and so forth. So you get this kind of distinction between people who put more emphasis on optionality and people who actually like to commit to something, to commit to a strategy, and to just solve their retirement problem. Of course, you always have to be ready to make changes over time. But that idea of commitment can really give peace of mind to some individuals. And so when you cross that with the safety first, do they want protections versus the probability based, are they comfortable relying on the market growth? You can really start to see how the different types of retirement strategies that exist really can fit into the different ways those types of preferences mix together.
Yeah, I really appreciate that explanation, Wade, because the beauty of the RetireSHIELD is that we talk to each individual client, have a relationship visit. We want to understand what their unique goals, desires are, and then take into consideration all of those different facets, whether or not it's, okay, for this portion of your assets, we want to create, commitment for income. For this portion of your assets, we want to ensure that there still remains optionality and liquidity and ease of being able to take advantage of new opportunities that might arise. But where we always will stay is with a safety first mentality. And the reason we use a safety first mentality at our firm is because we want to make sure that we can land the plane for our clients. But with that being said, I want to thank Wade for taking his time to be here today. It was truly an honor to speak to you, sir. And we just thank you so much for being here. And I'm gonna give it to Morgan, let the folks know out there how to get in touch with us.
Absolutely. Well, again, it's that time. We have to take the break for the day. Wade, We're thanking you. What a treat it was to have you. We always have great guests, but congratulations, Casey. Nice get Wade Pfau on the program. So RetireSHIELD TV, you're locked into it, and we hope to have you back very soon. All right, so coming up, we're going to give you an opportunity right now to get that peace of mind when it comes to your retirement. Remember, our lines are open, and they are open 24/7. So call the number on your screen. Again, call the number on your screen, or you can visit RetireSHIELD.tv to get your free copy of Casey's book, Baby Boomer Retirement Bootcamp, or to have a personalized RetireSHIELD plan created for you by Casey and his team of financial advisors.